Good afternoon, everyone, and welcome. My name is Helen Batistas, and I'm the Executive Director of the Milton District Hospital Foundation, and I'll be your host for today's webinar. Welcome to an overlooked gift, leveraging life insurance to everyone's benefit. Now, this is our third and final webinar for this fall. With so many options for life insurance, we thought it would be useful to outline some of the common uses for insurance that can benefit you, your family, as well as your favorite charities. But first of all, some housekeeping items. We are recording this webinar and we'll send you links and a copy of the presentation to you in the next couple of days. You are all currently muted, so if you have a general question or comment, please click on the chat button at the bottom of your screen and type in your question and we will answer it. Please avoid any personal information in these questions. We'd like to keep them very general. But before I begin, I thought I would take this opportunity to provide you with a quick update on our amazing hospital here at Milton District. We all know how special Milton is as a community, but please know how very proud we are of our community who have rallied for our frontline workers this past spring and throughout the summer. We were so happy to hear on a daily basis how grateful our staff were for your kindness and for your generosity. We want to thank you all and acknowledge the many donors who have stepped up to purchase the much needed equipment for our hospital. Just so you know, our hospital continues to ramp up its services, beginning to schedule more orthopedic and gynecological services, as well as opening our clinics and of course, our surgeries. As you may also be aware, we're allowing one patient visit to ensure our families are connecting while also adhering to the tough safety procedures laid out by public health. So now on to our session. I would like to welcome Catherine Pretty to share expertise in life insurance. Catherine is an RBC Living Life Benefits Advisor with skills in providing governance, wealth, and life solutions to families, businesses, and the charitable associations. Catherine will focus on solutions, goals, and protect your most important assets while showing you how to support your charities of choice. So Catherine, I'm going to hand this over to you.
Thank you, Helen, and it's a pleasure to be here. And certainly from RBC Insurance, we want to say first and foremost, thank you to the frontline workers, the doctors, the staff, the technicians, all the support staff at Halton Healthcare and Milton District Hospital. I know that you have been given thanks, by way of comments and emails and donations, but honestly, as a resident of Halton, what you guys do is amazing, and we're really, really proud of you, and we're very thankful that you've been for, helping us in our need this past 6-8 months. So, I can't underscore how much Halton Healthcare means to us. So thank you very much. That's great. And just as a side note, I just wanted to say that during this difficult time that we've all gone through, I did have the opportunity where we tried not to, obviously, but I had to bring my 2 daughters in for emergency care for something that they were looked after. And I was absolutely, astounded again every time at the level of care, but how proficient and how calm everybody was in emergency, the doctors, the nurses. We walked in and we were scared, we needed treatment. And of course it was during COVID, and everybody was so calm. They directed us, they made us feel like it was okay. There wasn't a panic. And just the experience for that 1 hour, 1.5 hour in emergency was phenomenal. We were all color coded and shuffled through in the right way. There was no panic. So it was really an experience a great experience I wasn't expecting. So you guys do a phenomenal job, even during a crisis. So thank you.
Well, thank you for sharing that, Catherine. We hope people don't need us, but we certainly hope that if you do need us, not to delay and avoid coming to the hospital. It is a safe place to come to. So thank you for sharing with us.
Absolutely. And we're glad to be here. So thank you.
So Catherine, is this an opportunity for anyone to make a gift of insurance? And what are some of the myths about insurance?
Yeah, absolutely. So insurance is probably a one area where people think they know what it's about, but there's a large opportunity where people will probably walk away after this uh, information session and say to themselves, I had no idea we could do this with an insurance policy, or I had no idea that insurance could work in this way. So it's, you know, this is a great opportunity to be able to debunk some myths about insurance and just how flexible and easy an insurance policy can work tailored to you and your life and your household. And as well, specific to today, this isn't just for the wealthy. I have a lot of clients who say, because we do talk about estate planning and beneficiary designations, and a lot of my clients say, well, I'm not wealthy. You know, I'd love to give, but I don't have, you know, a large sum of money just sitting aside. And this is one of the myths. Donating to a charitable cause in this manner is really easy, and it's in fact quite affordable. What you're doing is you're just streaming the funds in a way to help them grow, so that the money you do want to give to the community or your charity has a bigger impact. So this is for everybody, not just for the super rich and the wealthy. This is for anybody who wants to give a little and have a bigger impact.
So how is charitable donations outlined in this case for donors?
Yeah, absolutely. So donating to a charity, which we all know we can do, and many of us are used to it. You know, Canadians, when we think about donating to charities, it's maybe a one-time gift on certain occasions, or an annual gift through local events and fundraising events that kind of jog our memory when we're out and about, and we decide, oh, that's a good cause, I'll donate. And of course, you know, donating in terms of volunteering in lieu of funds. Some people say, you know, I don't have a lot of extra cash on hand or cash to give. I'll give my time. I'll give my expertise, which is fantastic. In terms of, you know, donating funds or a little bit of wealth, it's actually encouraged by the Canadian government. So the donor who gives, you know, a fund either in year or through the estate is actually given a tax receipt. And you can work the life insurance policy around getting a tax receipt in life, or, you know, through your estate and doing an estate, optimizing your estate. And basically it's very easy. Canadian government promotes this. Any charitable donation, a tax receipt is received, and that could be through a life insurance policy, an RSP, or a RIF. And all that needs to be done is that there is a designated beneficiary highlighted on that policy or on that fund, and in order to issue the tax receipt. But it's very easy, and again, the government does encourage it because it's all in our best interest to give to our community.
So how does life insurance help charities?
Absolutely. It's a great investment and donation tool. So what it does is it allows somebody to take what they would have is maybe a little bit of extra money every week or every month. And what we do is it's put into a policy, it's put into sort of a structured environment where it's secured and it grows. And the payout over time is significant. So for example, if somebody was to donate, you know, anywhere between $300 or even $1,000 or a little bit more a year, if they have that to give, we put that into a policy, designate the charity as a beneficiary, but over time, for example, 15, 20 years, or maybe even over a lifetime, that actually equates to, for an example, $50,000 to $70,000. And we don't often think of, you know, an individual, certainly myself, as saying, you know, I don't have $70,000 to give, but we do. It's just structured in a way where it's saved and it's funneled, and it allows to grow some wealth. And then, of course, when we do donate it as a charity to a charity, we get that tax receipt back. So doing it through a life insurance just allows the funds to grow, so it's more impactful.
You talked about designation. Can you explain what a designation is?
Absolutely. So designating a beneficiary is really, who do you want it to go to? So it's in an insurance policy, and basically it says that during, at the time of death, and sometimes before, but at the time of death, I want this money to go to somebody or a charity. And it's a very simple form. And what it says is this money at the time of death will be allocated to those who are listed. And it can either be 100% to one person or one charity, or you can split it percentages. And in an insurance policy, anything that the death benefit passes tax-free in Canada. So, which is a great advantage. And that's another reason why placing funds in an insurance policy with the intent to gift it as a donation, you're getting a little bit greater impact for that money that's invested. Now, there's also, with some policies, a cash value that could have accumulated. And the cash value gives a policy owner some flexibility as well, which we'll talk about later. But you can either extract some of that cash while you're living and optimize tax receipting during your lifetime, or it can stay within the policy and then all of it goes at the time of the death to the designated beneficiaries. But basically what that means is the people who, or the organizations listed on that policy as a beneficiary will receive that money tax-free. It also bypasses probate, which is very important.
Yes.
So if you don't put a beneficiary on your policy, it will go to your estate, and then the estate handles it and goes through probate. And certainly in a time when somebody has passed away, a lot of that money that is left is needed. It's needed to help with the death benefit and to help the surviving family, or you certainly want that money to go to charity as soon as possible. So definitely put a beneficiary on the policy, because you don't want it tied up in probate. That could be a very, very long process. Now, if you have a policy, dust it off. Chances are it's not sitting out on your nightstand as evening reading. Dust it off and review it. A lot of people forget they have a policy. I've had clients say, geez, I forgot I had this policy. And sometimes you have to update it. Life changes. The policy you took out perhaps 10 or 15 years ago might not be relevant. You might have had, a breakup of a household or a marriage, or you now have a new partner, children that you might not have had before. So it's really important that everybody reviews your life insurance policy every few years so it remains relevant. And if you don't have one, it's an excellent time to start thinking about it and reach out to somebody for a little bit of information on what's the right solution for you. And again, make sure you designate a beneficiary that's somebody outlined in the policy so that they are guaranteed that amount that you've specified without it going through probate and through the estate.
So what are common reasons to gift an insurance policy?
Absolutely. And I think, there's some reasons that people, maybe it's not front of mind, but charitable gifting with insurance it's very easy. And there's lots of advantages. One, you can tailor it to you. It all depends on how much you want to give. If you have a little bit of money each week that you want to put away, that's how we will structure the policy for you. And as well, if you say to yourself, well, geez, I'd like to have the benefit of those tax receipts during my lifetime, my working lifetime, or in my retirement years, we structure the giving and the term and the amounts around that. So it's really tailored to your life. Would you like to receive a benefit of the tax receipts now or later, or perhaps have it go to your estate? And a lot of people don't realize that you can actually use this as estate optimization. That sounds like a big word. Really, it's just estate planning. But what it means is you're maintaining the absolute value, the most value that you want for all the hard-earned assets that you've worked for and acquired over your lifetime. And you're making sure that you're paying, or your estate is paying, the appropriate amount of taxes, that you're not needlessly paying excess taxes when you could have, structured some of your assets or gifting throughout your lifetime to keep that tax rate low. And another big one is, and this is, I think, ingrained in all of us as Canadians, we want to give back to our community. I think we all understand the value of community services and not-for-profits and charities. And I do believe that everybody wants to give back, and this is a great way to do it. Some people would like to leave a legacy. One of the areas that I think is not fully understood is how corporations can leverage a policy to give. And I'll talk a little bit about that later. And of course, managing the tax credits throughout your lifetime. I know for us and our family, what really drives us and our decisions around what we've left in our will for charity is, obviously, optimizing our estate. What's most important is just giving back to the community, and if and just getting that tax credits that we can take advantage of. So that's sort of the three for us. But there's an important reason to give through life insurance that probably pertains to every aspect of life, whether it's individual or for businesses.
So what kind of policies are available, Catherine?
Well, there's, and I think this is one of the areas where people start scratching their heads and they know about life insurance and maybe they've had a policy, but they don't really understand sort of the difference between A and B. But there's about 3 or 4 very, very common policies out there. And most Canadians at one point or another have probably had what's called a term policy. And a term policy is, it's very basic, easy to understand, very affordable. We've probably all had one at some point, but it is exactly what the name says. It's a term policy. So it's anywhere between 10 and 40 years is the length of the term. And basically, if somebody passes away during that term while your policy is in force and valid, the death benefit is paid out to those who you've named as beneficiary. So it's very, very simple. The thing with the term policy is they all end. So it's very important that if anyone is listening, if you have a term policy, you really understand when it ends, and that as the policy owner, you make sure that you plan around either renewing it or converting it or doing something with it. Don't let it just end and think that it's going to cover you for your whole life. So just take a look at your term policies, but they're very easy to understand. The other policies which are extremely common is called a Term 100. And basically it's a permanent policy, very simple, affordable, but it's permanent. And it covers an individual for their entire life, paid up to age 100. So if you're lucky enough to live to 105 or 106, it's paid up at 100. And it's very simple in terms of relating like a term policy. When you pass away, the benefits are paid out to those who are labeled as a beneficiary or a charity. So very, very simple. The other types of policies out there, again, a permanent policy, which means it covers the life of the person who is insured, most commonly referred to as a universal life or a whole life. And a lot of people have them. There are some differences in terms of the details in the policies, depending on who the insurer is, but generally speaking, they're very common, permanent, and most have a cash value. And this is a really interesting aspect because what it does is it doesn't just cover the death benefit, but there's a little account in it for some that do have the cash value that grows. And the money that grows in this side, we call it a side account, grows, it's kind of like in a protected account, and it grows in a tax-advantaged environment. So what that means is, you're paying for your life insurance policy, which covers your life, and there's a death benefit to it. Then on the side, there's a little fund that's growing money in a segregated fund, and it's identical to a mutual fund. And a lot of people are very familiar to mutual funds. You're just investing in a pool of funds, whether you're a balanced investor or a growth investor, and that money grows for you. And that's all it is. So the universal life or the whole life policies have an option where you can grow cash inside the policy. It covers the person for their entire life. And when the owner passes away, the death benefit, much like the Term 100, is paid out to any of the designated beneficiaries or charities. And if there's any cash value, any wealth that has grown in it, there's a few things that the policy owner can do. You can actually extract some of that cash at some point in time while the policy is in force, if you want to donate it. And there's a little bit of process and regulation around how that happens in the tax proceeding. Or all of it can stay until the owner passes away, and then all that entire sum then gets passed on to the beneficiaries. But it's a great way of growing a little bit of wealth over time, and you can actually use that wealth before you pass away. And I'll explain how that would work as well. But it's an extremely advantageous policy to have, because you're not just paying for the insurance for your estate with your death benefit, you're actually accumulating a little bit of wealth that you might be able to use during your lifetime. And then the last one is in terms of sort of a product, like a protected product, is an annuity. And basically what that is that's an amount of money. Most have it in their retirement years. It's amount of money that's sort of sheltered in an account. And really what you're doing is just extracting an income stream, generally speaking, during your retirement. And you can absolutely assign a beneficiary to that. And that tends to be a little bit of a missed opportunity, is assigning a charity to the annuity as well. So those are basically the four main types of insurance concepts out in the market.
So Catherine, how would this work specifically based on types of policies and tax proceedings, and what would this look like, and what are the options for donors and individuals?
Yeah. So for the concepts that I kind of highlighted, you know, the term, very, very simple. It has a specific time frame that it's valid, or the term 100, or even the UL or the whole life policies. You can do the same thing with them. So the first option is the charity becomes the owner of the policy, and they're also the beneficiary of the policy, and then the donor pays the premiums. So that's the first option, and then I'll explain how the charitable tax proceeding works for that. The second option is the donor owns the policy, pays the premiums, and designates the charity as a beneficiary. The second option is actually what we most commonly think about, I think, with life insurance. You know, we take out a policy, we own it, we pay for it, and then on our death, the payout happens. So that's number two, is a really common association around policies. The third option is the donor's estate is beneficiary. So any of the money is designated for one or more charities is paid through the estate as well. So there's three options, number two being obviously the most common, but number one has a lot of advantages, and it all depends on the individual and what you would like to do with your wealth and your funds over your lifetime. So it's a very personalized approach to how you want to give over your lifetime. A little bit about the first option. So the number one option specifically, I can explain about how that's given and receipted on the next slide. The charity becomes the owner and the beneficiary of the policy, while the donor pays the premiums. So, and this is a really great opportunity, and especially for myself, where I said, you know, I do have an extra, you know, $70, $80 a month. I'm going to take out a policy and, you know, make the charity, make Milton District Hospital the owner and the beneficiary. I'm going to continue to pay the premiums. And it's a very simple form. I just assign it over to the charity, to Milton District Hospital, and all of the subsequent premiums I pay, they qualify as a tax receipt. So it's very simple. So you own it. You are the beneficiary. When I pass away, you receive the funds, and while in life, I get the benefit of the tax proceeding. And this works certainly for some households and for people who are trying to manage their income, their tax proceeding, and maybe offset any type of gains. So this is somebody who definitely wants to give, but is actively, you know, they want that benefit during their lifetime, not the benefit for their estate. Now, there are some policies, just as a little side note on the first one, there are some policies with the cash surrender value, as I spoke about before, that has that wealth that grows into it. At the time of the donation, the charity will issue an official tax receipt for the amount of the cash surrender value back to the policy donor. So that's another way of, giving to your favorite charity while you're alive and also getting the benefit of that tax receipt. And that's okay, that's encouraged. The Canadian government encourages us to give, and we get the benefit of that tax receipt. So it's a really great, way to give and offset the benefit as well. The second way, which is again the more traditional way, I think people think about life insurance policies, is we own the policy, we pay the premiums, and then upon our death, the charity who is designated as my beneficiary in my policy receives the money. So the tax receiving in this case is that the death benefits paid to the charity, it's considered a donation by the person made before their death. Now, the donation is claimed on the client's final death tax termination return for the prior year. There's no tax credits during life. So, while the policy owner is paying the premiums during life, there's no tax receipting at all. No double dipping. You can't have the benefit of the tax receipt while paying it and then the lump sum tax receipt to the estate. So the receipting only happens one time. But the donation is calculated at 100% of the net income. So this is number two, again, is probably the most commonly understood way of giving. And then we have the third common way of donating a life insurance policy, and that is where our estate is the beneficiary. And, if I want to give 50% to a charity or 100%, that's already outlined in the outline, and then it's paid through with my estate. The tax receipting in this scenario is the client doesn't receive the relief, much like number two, as they're paying for the premiums. It's only calculated through the estate on the termination, the death income tax filing. And just as a side note, though, because I did speak to an annuity, annuities, which is basically an account with an income stream that you've set up, typically in retirement. So that income stops on death. So in this case, what the client can do is again, the client can claim the charity as beneficiary, and then the remaining funds would go to the charity, and then there would be a tax receipt to the estate from the charity. So those are sort of the three very common, very simple ways of giving, assigning the beneficiary, and when you would like to receive that tax treatment, either in your life, have it go through your estate as well, or if you do have a policy that you would like to extract a little bit of the wealth during your lifetime, you can do that as well and gift that lump sum. So three very basic concepts. I did provide a few examples that I can share with everybody as well.
That's great. That's great information. Thank you, Catherine.
Good. So the first one, and this is just really illustrates the three concepts of gifting and what the insurance policy would look like, how you would set it up, and really the ease of doing it. So the first example would be to say, I would really like to give, a larger than I thought gift to my favorite charity or to the Milton District Hospital. So a $50,000 gift is actually for female, and I'll just preface this by saying I just took some general numbers, age 55, non-smoking male and female, healthy rating. A female would be about $76 a month, and a male, $92 a month. If people are wondering why the same amount, for life insurance policies, men are rated a little bit higher. But $76 a month for female, that's about $850 a year premium, which actually, to a lot of people isn't a lot. When I talk about this, my clients are saying, holy smokes, I can do this. You mean for $850 of funds that I know I have, I can give $50,000 to a charity. So again, this is just a way of very thoughtfully and purposefully taking money, a little bit of money that you have each week, and putting it into a protected policy that can generate some wealth for you. So $50,000 gift, $76 or $90 a month, will generate, quite a sizable gift to the charity. And this is what a term 100 would look like. Again, it's very easy. The policy is paid up at 100. If the policy owner passes away, the death benefit is paid out and tax receipt to the estate. Now, the nice thing about this is when I look at this, I'm thinking, oh my gosh, $75, $76 a month. That's like one pizza night in my house, having it delivered here. Two large pizzas and a pound of wings. That's $75. But so that's kind of where we were at with our home and our planning, charitable planning. So now the next one is the permanent policy. So this is where, and I took the example, a universal life policy, just as an example. Again, they're very common, affordable. They have a cash value feature, most of them, that grows. And again, that's that side account where the cash is growing from a fund, a pool of funds, much like a mutual fund pool, but it's growing in a protected tax advantage shelter. It covers the lifespan of the individual until they pass away. And when they pass away, the death benefit is paid out and any of the accumulated cash value is paid out as well. Now that's assuming that the owner has not extracted any of that cash during their lifetime. So it's paid out. You can, divvy up who you want to have the beneficiary money. It can be 100%, it can be a portion. And just a note that, if there is a discussion around, you want to take out some of that money, which could be quite sizable in the policy earlier, you're just going to have a discussion with your tax specialist or your accountant. Sometimes they're both the same, just to understand what can occur. And this isn't a negative conversation. This is, again, a really thoughtful conversation around, when's the best time to give. So maybe it's year 14, year 17, maybe it's in year 20, where you have a policy that has grown, maybe over 15, 20 years. You have a sizable amount of money that has accumulated and grown in it, and you want to give that earlier and then leave the death benefit for later. So it's just around it, having just that thoughtful conversation to say, when's the right time? How much income do you think you'll be earning in 15, 18, 20 years? Is year 20 the year to do it, or is it year 18? Will I be working? Will I be retired? And it's just a really simple conversation so that you have the greatest benefit of that tax receipt coming back to you while you're alive. And you can also give the biggest, cash gift that you can to your charity that you love also while you're alive. So, and again, these are very, very affordable. The scenario I picked was a $50,000 benefit, $77 a month for a female, $92 a month male, and in that is a little bit of wealth. So you're paying for a portion of it is the insurance. So that's the $50,000 death benefit. And then part of that premium a year is also going into that fund that's growing as well. So it's really taking, $77 and making a huge impact. And, in 20 years, that could be $70,000. So this is how wonderful this insurance product can make, a little bit of money each month grow into something really substantial for the charity and, of course, for your estate.
That's wonderful information. Thank you, Catherine.
And then the third one is, again, a paid up policy. So it's a permanent policy, very common, a universal life or a whole life. Most, will have a cash value feature again. But again, there's this side pocket of money, this pool of money that's growing in it. But for example, if somebody says, I really want to do this, but is there a way where I can do it and I'm not paying from, age 45 until my death? Can I do it in an accelerated way? And I often have a lot of people ask me that who volunteer with a specific organization because they want to make sure that while they're volunteering, they have the greatest impact, maybe over, 10, 15, or 20 years. So you can absolutely do an accelerated policy where you're paying up that full amount in a shorter period of time. And the premiums would be a little bit higher, but again, the policy owner and the donor is in complete control. You decide how much you want to pay a month, and you decide what length of term you want it for. Is it, 15, 20, 25 years as opposed to waiting until death? So there's a lot of flexibility, a lot of affordability, and the policy owners, you are in complete control of what's happening. So definitely you can do it in a very, very short term, give a lot of money within 15, 20 years, or you can spread that over for the balance of your life, your time horizon. Excuse me. And the next one I just wanted to sort of touch on in terms of giving is the opportunities that I had shared earlier, giving a term policy, a permanent policy, or a permanent policy with wealth, or a paid up policy. I do get questions on business owners. So the great part about this is if you own a business or manage a corporation, you can actually gift as well. And this is a really interesting conversation. So if there's any business owners on the line right now listening, we can certainly go a little bit deeper. But there is some advantages to actually giving through your corporation. And this is one where you would work specifically with your life advisor and your tax accountant, your tax specialist, your accountant within the company. The premiums are paid by the company. And I mean, typically, while deducting premiums, aren't typically possible, you have the company pay for the policy, and it's corporately owned. The benefit of this, and this is where, because there's a lot of small business owners out there, driving our economy, there's a lot of solopreneurs and small business owners. The benefit of being able to give or to have your company own the policy is the tax rate. So it's a little bit more advantageous. So the personal tax rate is higher in Ontario than the small business rate. And there's a benefit to that as well. So where from a personal tax rate, you would have to earn a lot more to gift the same amount. Putting it through your company, you can gift it and you're paying a lower business tax rate. So there's one advantage to it. Some of the other advantages to it on the next slide, and again, talk to your tax specialist, and of course your company if you are a small business owner, is the capital dividends account is an option. So what it does is it's used to direct proceeds of the insurance policy tax-free at the time of death of a shareholder. So again, the policy is owned corporately. It's done to solve some what we call inequalities in premium rates that could come with an individual paying for their own policy. Again, individual tax rates versus corporate tax rates. And it's available for universal and whole life policies because they typically have a cash value fund that grows in it. And not to go too deep, but for those on the line, basically what it means is if you have a company, the capital dividend, it's a type of payment it makes to shareholders. So the payment is taken out from one account, the capital account, and not from the retained earnings. And as is the case with regular dividends, if that's how you're paying yourself through your company. So when the capital dividends are paid out to shareholders, they're not typically taxed because the dividends are viewed as a return of capital that they already invested. So, we can do a whole other series on this, but there are opportunities for small business owners. If you're on the line, just reach out and we can talk about, is this a good option for you? But certainly businesses can donate to charities as well. And we can help you, reach out, we'll help you set this up. So there's a lot of opportunities here. Now, there's different ways to do this. Again, different policy options are available. The one thing that I really want to share with everybody is it's so flexible. So you can choose the policy, you can choose the amount, you can choose the term, you can choose, what fits your life, what is it that you really need, tax receding during your life. And it also fits your giving needs. When I talk to clients about this, the opportunity that they now have to say, oh my gosh, I didn't realize I would love to give, $50,000. I didn't realize how affordable it was, and we can do this, and it's very easy, to my favorite charity. And every policy is unique. So while there's 4 basic, kind of policies out there, term and term 100 and permanent policies, you can customize it so that it fits you, your estate. And if you want the tax benefits now, if you want it later, or you can do a mix of both, as in the case with a policy with a cash value, you can take some of that money out earlier, that has grown, and you are in complete control of what's happening. So it's really just a fantastic way of being in control, giving a lot more than you thought you could now, and managing your estate. We work so hard over our lifetime, with our incomes and trying to have a home and build an estate, and a little bit of a security nest when we retire. It's also a way of making sure that we're really optimizing the most value we have out of our estate as well. And it's simple. It's very easy to do.
This is all wonderful information. Thank you, Catherine. But how does a donor start this process of gifting life insurance?
Yes, absolutely. It might seem, okay, where do I start?
Right.
The first place to start is to say, to yourself, I want to give. I have a policy, I'm going to review it. I'm going to change the beneficiary status on it. Hopefully you do have a beneficiary on your current policies. If you don't, that's, definitely we need to change that. But there's a lot of expertise out there. So the first place you're going to go to is a licensed insurance advisor. If you don't have one, contact us, absolutely. They're experienced and they understand, this is a very personal process. So that's the first one. Certainly if you are considering donating a little bit more, or if you have some wealth that you need managed, definitely check in with a tax specialist, because you want to make sure that you're getting some insights on how you're going to manage your income over your lifetime, how you're going to manage your income and what you're going to live off of your assets when you retire, and how you minimize the income tax that we pay every year. So, a tax specialist, that could be your accountant. Sometimes they're the same person or not, but just have a check-in with them. And they're always happy to give as much information as you need on what's right for you. The other one is a lawyer. Now you don't, and what I mean by that is, if you have a family, solicitor or lawyer that's done up your will, you don't have to go out and do anything different, but just make sure that anything in your policy you have now aligns with anything you might have with your will currently, with your lawyer. The reason is, first of all, if you pass away, there's no unexpected shocks by your family. Something that sometimes pops up is, maybe mom or dad pass away, and they pass away and the kids didn't know that there was an insurance policy where they've gifted, $50, $100, $150,000 to a charity that's important to them. The kids are in shock because they're like, wow, that's amazing. I wish mom and dad had told us so that we could also help give a tribute to mom and dad. This was clearly important to them, and they want to be a part of the conversation. So that's one reason why, you want to have it sort of framed up in your will that you have it and where it's going, so that there's no shocks. And as well, when again, mom and dad pass away, just everybody's in the know, because there's nothing worse than finding out something big that the families at least should have been looped in on. So that's the other one, is just making sure that there's transparency. So that's where sort of your lawyer or solicitor would come in. And as well, let the charity know. And the reason for that is, again, much like yourself, Helen, you guys are expert in philanthropy. You know, you live in this world and you understand and you can share your knowledge of when's the best time to give and receiving. So it helps optimize that person's estate. Let the charity know. The other reason is the charity wants to give you a tribute while you're alive. You know, they want to recognize you as being a donor to their cause. So there's so many reasons why you should also let the charity know. But definitely, you know, and if you own a business, you know, you're obviously tied into your accountant or your tax advisor periodically, let them know as well, because they are going to give you the best advice. But your first stop is your licensed insurance advisor. And we're all going to make sure that we understand how to optimize your growth. We want the, you know, the $70, $100, $150 you're putting into your premiums to grow as best we can for you in that tax advantage environment. We want you to have that benefit of the tax receding, and so does the government. And we're going to help you grow your money so that what's really important to you, that charity, can have the biggest impact. And we're going to make it easy. Setting up a policy for this type of donation is very easy. There's lots of expertise out there, and you are in 100% control of how you want it done.
What a great session, Catherine. Thank you for helping us end our series this way. I think you offered us some great discussion points for our families, as well as to reach out to our professional, our allied professionals going forward. So thank you so much for sharing all of that. So now let's turn over to some questions. We do have one question that has come in, and that is, how long will I need to pay premiums on a policy when I give it to a charity?
Excellent question. That depends on how it's set up. If you choose to pay the premiums, for example, on a term policy, and you simply make the charity the beneficiary, then that term policy means, or the term 100 means you will pay it until the day you pass away. So, and of course we never know that. So that's the simple one. The other option is you can do a paid up policy. So where you say, you know, I want to give, but realistically, I don't think I can give a lot once I retire, or maybe I only have a specified amount of funds, you know, when I'm working and kind of going into retirement, and I only want to pay for 15 years, you tell us that, and we will set it up specifically to suit how long you wish to pay for.
Excellent. I know in your presentation you have a series of common questions that will be shared with the presentation. So I encourage all our participants to take a look at those common questions, and perhaps there's something there that you can learn as well that may not have been covered in our wonderful session. Though I think, Catherine, you've done a superb job. So thank you for taking time to meet with all of us. We certainly appreciate it. We are coming to the end of our presentation, so thank you everyone for joining. As I mentioned at the outset, in the next couple of days we'll be sharing a link to this webinar, as well as a copy of the presentation that Catherine has put together for us. So thank you again, Catherine, for doing all of this and for your expertise as well as your time. We certainly appreciate you doing this for us. Please also let us know your thoughts, our participants today. Please share your thoughts with us on what future topics you may like to see us put together and present for you. So finally, again, thank you everyone for joining us. Have a lovely afternoon and enjoy the weekend. Thank you again.
Thank you very much.
Okay, bye-bye.